Hello, this is Brian Shannon from AlphaTrends.net. Today's Monday, the 28th of April, 2008, and the market's closed. It seems like the market might be getting a little bit tired in here right now. So we want to just, I think, be a little bit more careful. And what I did was just change the scaling so we can see a few extra days on this S&P 500. But we're, unable so far to get past that 140 level that we've been keeping an eye on, as this market has had numerous attempts at it here the last few days, and it seems as though it's just losing some energy. Now you see today's volume was very low, just a lot of, just a lack of conviction, I guess, more than anything. When we look at the 30-minute time frame, we've been keeping an eye on this 140 level, and then this, cup and handle I had pointed out on this 30-minute time frame on Friday. The market did hold above that level, so for now that does continue to remain an area of support right here at about 139.50. Below that we have the trend line, the rising 5-day moving average, and of course I think the more important level is this 138 area. If you take a look at this 30-minute time frame, what you'll see is what kind of looks a little bit similar to what we had going on over here, where this market made that big rally and then just kind of ground higher a little bit. It broke out, but it failed to hold on to those gains, and from there we saw, again, from a failed move came a fast move. I'm not calling this one a failed move yet, but I think breaking back below, certainly below the 5-day moving average, then I think you want to be a lot more defensive in here. But again, looking at the daily time frame, we're in an area where it makes sense, as I've been saying, to be cautious, basically because we're coming to some important levels on the longer term time frame. We've got the 140 level, of course, but when we look at the downtrend line, that's still a couple points away, as is the December low and the location of the declining 200-day moving average. And again, when we have indecision on these shorter term time frames, and then we look to the longer term time frame to see what's going on there and see if there's some clarity, what we see here is a market that's been rallying on diminishing volume up towards a declining 30 and 40-week moving average, and that's typically not a bullish scenario. Now, that doesn't pay us, obviously. The only thing that pays us is the shorter-term moves, for a trading standpoint, of course. But right now, we're getting a lot of mixed signals on various time frames, and just the look of where we were over there, and just kind of the feel of this market, I think we want to be a little bit cautious. You can see that the biggest volume in here today also came in on that last 30-minute bar of the day. So we had heavier volume towards the close as the market broke down below the daily VWAP in here, and that's where the bigger volume came in. So that does, again, continue to give us a little bit of reason for concern. The 138.5 though, I think you want to look at that basically, and then of course below that we've got 137. So breaking down from here would be a good reason basically to get very defensive, as we have a lot of mixed pictures from different time frames. The Russell 2000 was up 48 cents, or 0.67%. Obviously, again, I'm going to point out it remains stuck below this key level near $73 a share. And looking at the 10-minute time frame, you can see it's getting close up to that level again. And we had heavy volume here late in the day that it's tough to say what that is. It's it's one bar on the 1-minute bar, probably just market on close orders. But looking at this 10-minute time frame, you can see that it remains above these highs here. So I think 72, then back down towards that 71.25 to actually $71 level, where we had this resistance last week turn into found some buyers there, and it acted as support. Getting down to 71 would still put this market, keep this market in good technical shape. And again, we've got the 10-day moving average above the 20, above the 50, but near the high end of these ranges, we need to become a lot more cautious and pay more attention to any signs of developing weakness on the shorter term time frames. Again, we're not seeing them here on this 10-minute chart of the IWM, but just based on the important level of where we are in the bigger picture, it means we've got to pay a lot more attention and be ready to move to the sidelines if things become a little bit, if the sellers get a little bit more aggressive in here. Of course, we've got the Federal Reserve going to announce any potential change to monetary policy. That occurs on Wednesday rather. And this isn't actually the best trend line. The best trend line that's really been capturing this trend is drawn from the high right here in late October rather than this high. and you can see that the more times that was tested, we did finally see it break above that level on Friday. Again, though, this market remains more neutral than anything. Most important support remains down near 2440, which is right now pretty far away. 2620 has been an important level on the intraday basis, and I think still that clearing for 2750 or so, that would really put the buyers back in control here, I think, of the intermediate term. And when I say intermediate term, maybe 1 to 2 weeks, and we could see a bigger short squeeze rally develop from such a move. Looking at the hourly time frame, we've had our eye on this trend line that was broken on Friday, so that's important as well. Now, still, again, 27.5 or so, that's where I think we can have a little bit more confidence that maybe there's some upside potential in this market. But you need to be very careful in here still, obviously, as there's a lot of potential news still to hit for these stocks, so it just makes them more dangerous. The NASDAQ 100, again, on the daily time frame, we've had this downtrend line that this market's been testing. It's been testing it and testing it. It's unable so far to break past it, but again, the bullish thing is that it remains above the important prior level of resistance near $46 to $46.40. So if we do see some pullback down, the 46 to 46.40 area will be the more important level that we'll want to see this market hold above. Looking at the 10-minute time frame, we've got a lower high in here still. We've still been unable to breach the high from the 24th. I think breaking below 46.50 would really give us reason to move to the sidelines, and more aggressive traders might even want to get short for a move down, maybe towards that 44.40, basically 44.40 to $44 a share. That's the more important area. That this market could have the potential breakdown below. The 5-day moving average is flattening out. We have a lower high. It doesn't mean sell, but it means be on the lookout that if it breaks back below 46.50 or so, then you want to be a lot more cautious, and maybe, again, if you're a very aggressive trader, perhaps you could take a look at some of the inverse ETFs and take advantage of some further downside from there.